From the 12th of August 2016, we'll have to consider how the Insurance Act affects insurance policy claims. In my previous video, I explained how to assess whether an insured had disclosed relevant material circumstances and how that fitted into the duty to present the risk fairly. In this video, we're going to consider the remedies available to an insurer who has established that there has been a breach of an insured's disclosure obligations. If you haven't watched the earlier videos in this series, then I recommend that you do so now, otherwise you're going to get a bit lost. You should by now also have downloaded a copy of our distinctive booklet on the Act, so you can refer to it while watching the video. You'll find a link to the booklet on the page where you found this tutorial. So let's get started. This is page 3 of the booklet, and by now it should be familiar to you. If it's not, then you should watch the other videos in the series. I'm going to go straight to the end of this flowchart. I'm going to consider here what remedies are available to an insurer when they've established that there has been a breach of a duty of fair presentation of the risk. You'll see that to consider what remedies are available, you need to turn to page 13 of the booklet. This page explains all the remedies available to insurers. It looks very complex, but a lot of this page has to do with remedies relating to variations of policies. So for the purposes of this video, I'm going to simplify things. This is much more straightforward. If you've got this far, then you know that the insured is in breach of the duty of fair presentation. That is called a qualifying breach. The Act differentiates between two types of qualifying breach. The first is those that are deliberate or reckless. The second is those qualifying breaches that are not deliberate or reckless. So the first question to ask is whether the insurer can prove that the insured knew they were not making a fair presentation. That's going to require some evidence. If the insured knew that they were not making a fair presentation, the qualifying breach is deliberate. If the insured did not care whether they were making a fair presentation, then the qualifying breach was reckless. Either way, you follow the yes arrow to the left. If you work your way through the arrows, again assuming that we are not dealing with a variation, you will see that the insurer is entitled to avoid the policy, refuse the claim, and keep the premium. That's a slight change from the old law, where even if a deliberate or reckless non-disclosure could be proven, then the premium would have to be returned, but not now. There may be occasions where the retention of premium justifies the effort in gathering the evidence and proving in court what the insured knew. However, more often than not, an insurer will not want to go to such efforts. If the qualifying breach is neither deliberate nor reckless, then you follow the no arrow to the right, and if you are not dealing with a variation, you move your way down. Then you have to ask the question whether the underwriter would have underwritten the risk if there wasn't a qualifying breach. If they would have underwritten on different terms, then the insurer may amend the policy so that it is written on those terms. But the insurer can't charge additional premium, even if that is what they would have done previously. What they can do in that event is prorate the claim to reduce it proportionally to any increase in premium that they would have charged if the material circumstance had been disclosed. We'll look at how to do that in a moment. If the insurer would not have underwritten the risk, then the remedy of avoidance is still available. They can refuse the claim but will have to return the premium as they would have done under the old law. The real issue here is going to be evidence. An insurer is going to have to prove that they wouldn't have underwritten the risk, and to do that it would be necessary for the actual underwriter to talk about why they would have made that decision. Documents such as underwriting guidelines will help to support the insurer's position. Insurers that have a good paper trail and can justify their actions based upon established documentation and guidelines will be in a stronger position. The key change to remedies is the ability to prorate the claim based upon any increase in premium that would have been the result of underwriters learning about the material circumstance. So how do you prorate the claim? Well, that requires a simple calculation. To work out the percentage of the claim that should be paid, you need to divide the premium that was actually charged by the higher premium and multiply that by 100. That gives you the percentage. You can then apply that percentage to the full claim payment, reducing the indemnity to the insured. Let's use an example. Say the premium actually charged was £1,000, and that would have increased by £100 if the material circumstance had been known to the underwriter. Therefore, the percentage payment works out to be 90.91%. On a £1 million claim, that would mean the insured received just under £91,000 less than they were expecting. So that's how remedies work under the new Act in relation to non-disclosure and misrepresentation. It's a bit more complicated for variations, but the principles are the same. Just work your way through the flowchart to find out what your options are. This has been a close look at the remedies provided by the Insurance Act 2015 in relation to non-disclosure and misrepresentation. You can watch other videos in this series to learn more about the detail of the Act. I'm Michael Hogg, a partner in Kennedy's London office. The Insurance Act 2015, a distinctive approach.